Investing is one of the most effective ways to grow wealth over time, but even the smartest investors can make costly mistakes. Whether you're new to the game or a seasoned pro, understanding these pitfalls can help you save thousands, if not millions, in the long run. In today's video, we're breaking down the 5 most common investing mistakes and, more importantly, how you can avoid them. So stick around. This is one video you don't want to miss. 5 common investing mistakes and how to avoid them. The first mistake that many investors fall into, especially when they're just starting, is overtrading. With the rise of mobile trading apps, it's easier than ever to buy and sell at the tap of a button. But here's the thing. Constantly jumping in and out of positions can actually hurt your returns in the long run. Every time you make a trade, you're not just buying or selling, you're paying transaction fees. And if you're in a taxable account, you might also be triggering capital gains taxes. Over time, these costs can eat away at your profits. Research shows that investors who trade more frequently underperform those who take a buy and hold approach. My advice? Focus on building a portfolio that can weather the ups and downs of the market and resist the temptation to overreact to every fluctuation. Set it and forget it. Number 2. Focusing too much on short-term gains. It's exciting when a stock you've picked doubles overnight. But here's the reality. Markets are volatile, and what goes up quickly can come down just as fast. This mistake is particularly common when investors chase hot stocks. Companies that are hyped up in the media or on social media platforms. Sure, you might catch a winner every now and then, but trying to guess which stock will pop next is more like gambling than investing. Instead of trying to time the market, look for companies with strong fundamentals, solid earnings, manageable debt, and a competitive advantage in their industry. These are the types of investments that will grow your wealth steadily over the long haul. As Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. So be patient. Emotions are probably the number one cause of poor investment decisions. When the market's going up, people tend to get greedy, thinking that they can ride the wave forever. But when the market crashes, fear sets in and they start panic selling. This behavior is perfectly natural. Humans are hardwired to react to fear and greed. But in investing, emotions can cloud your judgment and lead to buying high and selling low, which is the exact opposite of what we should be doing. Here's a fact. Historically, the market always rebounds. So if you sell during a downturn, you're likely locking in your losses and missing out on the recovery. To avoid emotional decisions, you need to have a clear investment plan and stick to it, no matter what the market is doing in the short term. Investing is a long-term game. Don't let a bad day in the market turn into a bad lifetime decision. Next up is one of the biggest mistakes out there: not diversifying your portfolio. It's tempting to put all your money into one hot stock or sector, especially if it's doing well. But that's a huge risk. Even the best companies and sectors can experience downturns. That's why you need to spread your risk. A well-diversified portfolio includes stocks, bonds, real estate, and even international investments. When one sector is down, another might be up, balancing out your overall returns. Think of your portfolio like a safety net. The more threads it has, meaning the more diversified it is, the stronger it will be. Diversification won't eliminate risk, but it will reduce it. Finally, we have failing to do proper research. With the explosion of information online, it's easy to get caught up in the hype of the next big thing, whether it's a hot stock tip on Reddit or a cryptocurrency your cousin mentioned at a family dinner. Investing based on headlines, or worse, hype, can lead to disaster. To make smart investments, you need to do your homework. Look into the company's financials, its competitors, and the overall market conditions before you commit your hard-earned money. Remember, it's your money on the line. Taking the time to fully understand an investment before jumping in is one of the best ways to protect yourself from unnecessary risk. So there you have it, 5 common investing mistakes and how to avoid them. By steering clear of these pitfalls, you'll be in a much better position to grow your wealth safely and sustainably. If you enjoyed this video and found it valuable, please hit that like button and subscribe to stay updated on all things finance and investing. And hey, tell me in the comments below, What's the biggest mistake you've made as an investor? Let's learn from each other's experiences. Subscribe for more financial wisdom. Check out our latest video on building passive income. Follow us on Instagram and Twitter for daily tips.